Hey traders, welcome to the channel. Before we jump in, let me say this. The kind of content you'll find here is unique. You won't find this perspective anywhere else, at least not yet. A few weeks from now, you'll start to see similar videos pop up saying the same thing. But if you ever want to know where it really started, just check the release dates. You'll see exactly who broke it down first. Alright, let's dive in. We're going to talk about something that every trader using prop firms needs to understand: drawdowns, profit targets, and why so many traders keep blowing funded accounts over and over again. Now, I'm not going to name specific firms here because honestly, most of them use almost the exact same model, but once you understand how those rules actually work, everything about your trading approach will change. Let me start with a simple question. Have you ever wondered why you keep blowing prop accounts? You pass the challenge, you start trading, things look great, and then boom, another account is gone. Most traders think it's their strategy or that they just got unlucky. But the real reason is actually much simpler. It comes down to one thing: how much you're risking on each trade. Now, before we go deeper, let's make this interactive. Be truthful and honest with your response. And trust me, this will all make sense in the next few minutes. I want you to take a pause. Literally pause the video right now. And in the comments section, type out your account size, your risk percentage per trade, and your actual dollar amount that you're risking. Don't overthink it, just be honest. If you're risking 1%, 2%, 5%, or if it's 50, 200, 500, whatever it is, write it down. And make sure you include your account size too, whether it's 50K, 100K, 150K, whatever you're using. This isn't about judgment, it's about awareness. Because when we start putting real numbers in front of us, things become clear very fast. So go ahead, pause the video now, and do that before watching the next thing I'm about to share. Alright, now that you've done that, let's look at the numbers together. Most prop firms offer account sizes like 50K, 100K, or 150K. Sounds great on paper. You feel like you're managing big capital. But here's the truth. You're not really trading a 50K account. You're trading the drawdown. Now, I'm using the 50K account size as an example here and assuming 1% risk per trade just to make the math easy to follow. But let me be clear, 1% risk per trade is actually way too much, especially in prop firm conditions. We're not focusing on the risk management aspect in this video. That's a completely different topic I'll cover in another one. For now, I'm just using 1% as an example to help you visualize what's really going on under the surface. For example, a 50K account usually has about a $2,000 drawdown. A 100K account might have around $3,000. A 150K account is about $4,500. That means if you buy a 50K account, your actual account value, the amount you can truly lose before failing, is only $2,000. That's your real capital. That's the number that matters. Now here's where most traders go wrong. They apply the risk 1% per trade rule, which sounds great, but they calculate it off the 50K. So 1% of 50K is $500 risk per trade. Seems fine, right? But in reality, you don't have 50K, you only have 2K of real risk capital. So that $500 you're risking, that's actually 25% of your account on one trade. 25%, 4 losing trades, and you're done. Account blown again. It's not bad trading, it's bad math. Now let's take a second and go back to your earlier comment. Compare the risk numbers you wrote, your account size, your risk percentage, and your dollar amount to the actual account size you're trading based on the drawdown. Be honest with yourself and drop a follow-up comment. How much are you really risking per trade in percentage terms once you base it on your true drawdown value? And ask yourself, is that sustainable for the long term? Can you keep trading that way for days or weeks without blowing up? If the answer is no, that's the awareness you need. That's the starting point to fix your trading forever. Now let's talk about profit targets, because this is another area where most traders don't realize what's happening. A 50K account often has a $3,000 profit target. If you're thinking in terms of 50K, that's just a 6% gain, no big deal. But if you're thinking in terms of your real account size, your $2,000 drawdown, you're being asked to make 150% on your actual capital. That's crazy. So what happens? You start forcing trades. You over leverage, you start gambling, not trading. Because deep down, you know that hitting 150% with proper risk management is nearly impossible in that setup. And that right there That's why traders keep failing these challenges. It's not because they can't trade, it's because the structure itself pushes them into high risk behavior. You're playing a game that looks like trading, but it's designed to make you break your own rules. Now, don't get me wrong, prop firms are great for serious traders, no doubt about it. If you're disciplined, if you understand risk, and you treat it like a real business, it's one of the best opportunities out there. But they're not for gamblers. They're not for traders who risk big just to pass the evaluation, get funded, and chase that first payout. Sure, a few might get lucky, a handful might catch a good run and make it to a payout, but eventually the math catches up. Those same traders end up blowing account after account because their foundation was built on gambling, not consistency. Prop firms reward discipline, not desperation. So what's the fix? How do you actually trade these accounts properly? It's simple, but it takes discipline. Base your risk model on the drawdown, not the account size. If your drawdown is $2,000, that's your real account. If you risk 1% per trade, that's $20, not $500. Yeah, it feels small, but that's what keeps you in the game. Trading isn't about how fast you make money. It's about how long you can stay alive in the market. Survival is everything, because only if you're still in the game can your edge actually play out. Now, let me make something clear. I'm not just talking theory here. I use prop firms myself. But my risk model is based entirely on the actual account value, the drawdown, not the headline number they show you. So if I'm trading a 50K account with a 2K drawdown, all of my decisions, my position sizing, my stop losses, my daily limits are based on that 2K. That's how I stay consistent. That's how I stay funded. And that's how I avoid blowing accounts, even when the market gets tough. So next time you buy a prop account, pause for a second. Forget the flashy balance number and focus on what's real. The drawdown is your account. That's what you're managing. That's what you're risking. So think again. When you are buying a 50K account, you are actually buying a $2,000 account. And when you trade that way, your whole mindset shifts. You start focusing on consistency, risk control, and longevity, not gambling and hope. That's how real traders grow. That's how you survive in this game. All right, traders, that's it for today's session. Trade smart, stay disciplined, and I'll see you in the next one. Happy trading.